LTC Properties, ticker symbol LTC. This REIT is known for their monthly dividends and it's up 11% year to date. And that's quite strange since most stocks are down or up only the tiniest bit year to date. And with that being said, I think it's very interesting to do an analysis about this company to see if LTC is a buy or not. So in this video I'm going to check what LTC does, a quick view at the historical stock price performance, the fundamental analysis itself, the dividends, and of course their major competitors. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, what does LTC do? LTC Properties is a healthcare facility real estate investment trust that operates through mortgage loans, property lease transactions and other investments. LTC generates all of its revenue in the United States and considers merger and acquisition investment as a component of its operational growth strategy. LTC has 35 operators in 29 states with 198 properties, which sounds very good to me. And this also means there's plenty of room to grow, also because they only operate in the US right now. So there's a lot of opportunities overseas. And when we check the revenue breakdown, we see that 73.5% of the total revenue is coming from owned portfolio, and they collect rental income. Second segment is mortgage loans, with 24.3% revenue share, where they collect interest income. And both with 1% we have notes receivable and unconsolidated joint ventures. When we check the portfolio overview for the main segments, owned properties and mortgage loans, we see that there are two main property types: assisted living and skilled nursing. For the owned properties representing 73% of the total revenue, I think it's very balanced, with 39% of that 73% revenue coming from assisted living. And the other 33.8% is coming from skilled nursing. With the mortgage loans, it's a bit more one-sided. In total, this segment represents 24%, with 23% of this 24% coming from skilled nursing. Another interesting thing to see is the breakdown of the 35 operators. In here we see the top 10 operators and others combined. The top 10 represent 73.5% of the annualized actual cash, with Prestige Healthcare being the number one with 18.6%, which is quite a lot. To be honest, I would love to see a 10% per operator maximum. A very important thing for LTC is the projected annual growth rate of the 75 and 80 plus population. And in this graph we see the two important spikes. The first one in 2022 and 2023, and the second one in 2027 and 2028. So it's expected that the amount of people above 75 is growing, which is a good thing for LTC since they are investing in healthcare properties focusing on this audience. And now that we know more about LTC as a company, it's time to check the historical stock price performance to see what happened in the past 5 years and how the returns are with this company. I decided to compare LTC with the S&P 500, CTRE, GMRE and CHCT, all major competitors of LTC. On the 5-year chart we see that LTC has a return of only 5% in the past 5 years, including dividends, while the S&P 500 did return 87% including dividends. So this is already a huge difference and already tells me that you could better own a S&P 500 ETF. CTRE also underperformed the S&P 500 and GMRE beat the S&P 500, while CHCT was beaten by the slightest amount versus the S&P 500. On the 1-year chart we see that all are down except for LTC with a return of 5%. The S&P 500 is nearly flat though, with a minus 0.14%. On the 6-month chart we see that LTC returned a whopping 21% versus negative returns of all others. Even the S&P 500 is down 10%. On the 1-month chart we see a 12% return for LTC, 1% return for S&P 500 and a 10% return for CTRE. The last two are nearly flat. So now that we know everything about the historical returns, it's time to check the fundamentals to see if LTC is a buy right now. LTC is a 1.5 billion market cap REIT with a 155 revenue in the 12 trading months. Net income is sitting at 56 million. When checking revenue over a longer period of time, we see that since the coronavirus, the revenue went down and never went up significantly. Right now, there are no signs of recovery in terms of revenue, which is something that concerns me a lot. The PE ratio is sitting at 27, which is a bit different with REITs, so I don't want to spend too much energy on that one. Later in this video, we are going to compare it with the major competitors. Profit margin is sitting at 36%, which is fine by me. Return on assets, return on equity and return on invested capital is below 10%, which is something I don't like. So this is something to keep an eye on. You want these numbers above 10%. LTC doesn't have a lot of cash. Right now, total cash is sitting at 4 million and operating cash flow is sitting at 88 million. This means they are not capable of paying down a big chunk of their total debt with the free cash flow. Right now, debt is sitting at 762 million. To me, this is too high and a big red flag. But keep in mind that companies use debt to grow the business. So, as long as it's healthy, it's not a problem, but that's not the case here. For me, it's very important that free cash flow is growing, since this is used to pay down debt, of course, but also to do acquisitions, pay dividends, buy back shares and all other things. I know it's a bit different with REITs, but you want them to be healthy and also to have a growing free cash flow. In this chart, we see that free cash flow is decreasing, which isn't a good thing, so another big red flag. To be honest, the fundamentals of the stock don't look great so far. But how about the dividends? The thing people love about LTC. So, LTC has a 5.8% dividend yield and an annual payout of $2.28 a year. And as I already mentioned earlier, they pay a monthly dividend of $0.90 every month. The 5-year growth rate is sitting at 0.35%, which is really sad. And they grew the dividends for 0 years in a row, which is not related to the coronavirus. The last dividend increase goes back to 2016, which is also very sad. So I think 5.8% dividend yield is really high, and it's nice that they have a monthly dividend. But there's no growth, and to me that's very important when it comes to dividends. But as I said, a lot of people do like the monthly dividends, of course. The last thing I want to discuss are the major competitors versus LTC. Again, I decided to include CTRE, GMRE and CHCT. LTC has a negative 5-year compound annual growth rate for the revenue, sitting at -1%, while all the others have an increasing revenue. And it's the same story with the net income. The 3-year net income compound annual growth rate is sitting at -28% for LTC, while the others have an increasing net income compound annual growth rate. And again, it's also the same story with the EPS compound annual growth rate and the levered free cash flow compound annual growth rate. To me, GMRE and CHCT are a winner here. LTC does have the highest net income margin, which is really nice. And next to them, they also have the highest return on equity, return on assets and return on total capital. So LTC is the winner for me in this one. The last thing I want to check are the dividends. They all pay a high dividend yield, so you want to check the growth and the payout ratio to decide which one is the winner. Since REITs don't use the standard payout ratio as displayed here, I looked up the correct payout ratio. LTC has a payout ratio of 90%, while CTRE has a 73% payout ratio, GMRE has a 85% payout ratio, and the last one, CHCT, has a 70% payout ratio. The dividend growth is nearly flat at LTC, and CTR has the highest dividend growth of 9% in the past 5 years. So for me, CTRE is the winner here, since they have the highest dividend growth and the second lowest payout ratio. My final conclusion with this stock is that I think it's not a buy based on what I see. I do understand that monthly dividends are very interesting to collect and that it could be used to reinvest in other stocks, of course, every month. But with a 5% return, including dividends over the past 5 years, I think it's better to own an S&P 500 ETF and get a 90% return with less risk. But that's just my opinion. So remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.